welcome back to the podcast. Thank you very much for being here. We are going to talk about all things infinite banking, business, life insurance companies, all things. So thank you for being here. If you are a first timer, welcome. If you are not, thanks again for coming back. All right, today we are going to talk about the security of the life insurance companies. This is an extremely hot topic since we have had bank collapses and even the life insurance companies have reached out to us. We've talked about it a little bit before on this podcast as well, but we're just going to hit it again so that we can really understand what's happening and really what's happened in history to what's happened today. So think about this. These life insurance companies are like the company that I write with, 145 years old. Now, I write with multiple companies. All of them are over 100 years old. But the one that I write with the most in particular is 145 years old. So think about that. These companies were around before we were taken off the gold standard. They were around through all of the wars, through all of the pandemics. Really, if we look back at the swine flu, if we look back at any other type of disease that was killing people, life insurance was there. Now, let's get into a couple of things. The management of these companies. These companies cannot just willy-nilly turn money like the banks do. In 2020, the banks were allowed to keep zero money in reserves. That is extremely scary. Where was that when we were talking about the security of the banks, when we were talking about what was going on? Nothing. They just in the background do all this stuff, and then we don't even know that it's going on. And I had heard in 2021 that the banks went to a zero reserve. Now think about that. You deposit money in the banks and they don't have to keep any of that money. Zero zilcho. So what happens when there is a bank run? What happens when the bank's portfolios don't perform well? They have to go to the feds to bail them out, which is exactly what happened with Silicon Valley Bank. Is we didn't have even 1% of what we needed in reserves. That's absolutely ridiculous. Why? Why do they not have to have that? And it's interesting because when you look at the insurance companies, they are regulated by the state insurance agency. Well, even the state of North Dakota, there was a company that I wrote with several years ago, and they said, you know what, we're not writing in the state of North Dakota anymore because the state wants us to add language to our contract that you can take the dividend in cash. This particular company did not have that in their contract language. If they put that in the contract language, that means they would have to change the software. Now, at any time, I can go to an insurance company and say, I want my dividend sent to me in the form of a check. Now, a lot of them, it's just one little click of the software that says that we will do that. This particular company could do it. They just had to do it manually. The state of North Dakota said that is not okay. We want you to be able to do that manually. This company said, nope, we're not doing that for you, North Dakota. Therefore, we will not write business there. Now, since then, they've changed that, but it took them about 2 to 3 years to get that change done and to add 4 measly words to their contract. So when you are looking at life insurance companies, they're regulated by the states, and they are really regulated because it's a private company. The feds aren't going to be able to come in and just go, oh, well, we'll just bail you out. No, it's like any other small business, right? When the banks get bailed out, it irritates those of us that are small business owners because the bank is nothing more than a business. But they did a really crappy job of managing their business, yet they get bailed out at the cost of what? Us, the taxpayers. I was listening to a podcast last week or week before that said that the feds had money and now they don't have money again because they had to bail out Silicon Valley Bank. Well, if they didn't have enough money to have money in reserves. Why are we bailing out people that were actually not insured? They had more money than there was insurance. And I said this last week on the podcast because I'm sure the feds had to cover their own you-know-whats. So the insurance companies, so many people are wondering about the security. The insurance companies are extremely secure because of those things. They are regulated. Now, let's look at what has happened with some insurance companies that maybe aren't as secure as others. Nobody is perfect in any environment. So as long as I can sit here and say, oh, they're secure, no worries, there is not 100% guarantee on anything in this world. Nothing. Insurance is the most secure thing you can buy above a stock market, above whatever we're doing in the banks, right? If we look at history and what's happened. And they've been around longer than the Federal Reserve. They made it through the money being taken off the gold standard. That's a lot of the questions I'm getting right now is, Mary Jo, what happens if we have cryptocurrency coming in? What's going to happen with the insurance companies? Well, they're just going to adopt a new currency. Think about it. When we had a gold standard, everything was backed by gold. Insurance companies were around then, and we got taken off the gold standard, and everything just kept up just as it was. Now, how would that change if it was cryptocurrency? Currency is currency. What's going to happen with our currency when the bank says you can't, if the bank says you can't use a dollar, we're going to go to crypto. We're just going to change our means of using money. So many people are just really in this uproar about what's happening with our dollar. Am I paying attention to it? 100%. Am I super duper concerned that our dollar is going to crash? No, because here's something else I look at. We have been talking about the dollar crashing since the Federal Reserve started, and the dollar still has not crashed. Are we getting closer? Yes, possibly. But again, we've been talking about that forever. Everybody thinks it's going to happen in their lifetime. We've had 2 lifetimes go by and it still hasn't happened. And so paying attention is one thing. Freaking out about it is a whole nother thing to me. All right. So the life insurance companies have survived. Here is what I think is more important. And there is a gentleman by the name of Bobby Samuelson, who I am going to actually have on as a guest on the podcast. And Bobby writes a blog post and has a whole entire company based on evaluating life insurance companies. That's all the guy does, is evaluates these companies. And he just had a blog post come out talking about the very things that I have talked about on this podcast before, which is universal life, the pricing of products, all these good things. So when we look at an insurance company, yes, we want to look at where their assets are. Yes, we want to look at who's managing that money. But better yet, we need to look at, are they pricing the products correctly? How are they doing underwriting? And are the insurance agents paying attention to what companies are doing and what they are selling? So here is an example. The insurance company that I write with is extremely conservative. So it takes us about 4 to 6 weeks to get through the health underwriting, meaning that you are going to most likely have to do a paramed exam. They are going to pull medical records. Why is it such a long process? Because of the fact that we want to make sure the pool of people that we are insuring are healthy, that we are not going to have to prematurely pay claims. We also want to make sure that the price of that product is correct, that they are charging the right amount for cost of insurance. So here's what's happening in this space, is we have a bunch of agents who want to sell life insurance. And instead of looking at the company, they're looking at the illustrations and saying XYZ company is better than ABC company because it's cheaper. Okay, why is that insurance cheaper from XYZ company? Is it because they have underpriced their product so that they can sell more insurance? Then the agents don't understand what's happening, because a lot of agents, if you actually talk to agents, they do not understand the company side of it. They don't talk to the underwriters. They don't talk to the actuaries. They don't talk to the head underwriters. They don't talk to the CEOs. They have zero communication with home office. They look at numbers and they sell a product. I am talking to all of those people because it is extremely important to me. So if we run illustrations from two different companies and one is just buying way more death benefit than the other one for the same amount of premium, why is that? Why are you not questioning why they're not exactly the same? Why is one cash value growing faster than the other cash value on the non-guaranteed side, meaning dividends? Why is one company providing this massive amount of dividend while another company is not? If I have a company that's pricing their product more expensive, that is giving a lower dividend, is it because that company is being extremely conservative? Now, some people will say, well, they're being so conservative that they're just holding my money. Honey, it's not your money. The second that you pay premium, it goes to the life insurance company. It becomes their money. The cash value in your policy is a part of your death benefit that you are allowed to use while you're alive. It's not your money. It's contractually available for you to borrow against. But you are using the life insurance company's money. You gave them the money. They use that money to buy bonds, real estate, all of these things. And so you want to make sure for them to pay the claim upon your death, you want to make sure that company priced that product correctly. So in Bobby's blog post, what he was talking about is all of these companies that have financially had hardships. And recently, I believe it was Lincoln Financial, had to infuse billions of dollars into their company because guaranteed universal life is causing them a little bit of financial hardship, or a lot of financial hardship in reality. What does that mean? Okay, y'all know, if you've listened to me for any period of time, you know I hate universal life, variable life, and indexed. Why? Because the fees and charges in those policies are not guaranteed. They are not figured in. Most of those companies have sold a policy that they undercharged for the fees. Now, typically, if I buy universal variable indexed, if it's just a regular policy and the company undercharged for the fees, they will increase the fee and that gets taken from cash value. When cash value goes to zero, the policy lapses or they come back to you and ask for more money. Okay? A guaranteed universal life, a guaranteed VUL, a guaranteed indexed means that I mispriced the product, but I guarantee that even when your cash value goes to zero, there will be a death benefit until age 100, for example. Even though there's no cash value, even though that policy should have lapsed, we are still going to guarantee and pay the death claim. Now, this sounds fantastic, except when the insurance companies wrote those policies, they anticipated that those policies were going to lapse, meaning people were not going to continue to pay the premium. So they would not be on the hook for all of these claims. Well, guess what? People paid their premium. They were good stewards of their bills. And so now these policies have no cash value. The premiums are not enough to cover the charges, but we have to fulfill our guarantee as a company. So in order to do that, that means that on the books, it doesn't look good because we have to infuse all of this money into this product to make good on them because people are dying later. So the policy has no cash value. They didn't prematurely die. They didn't lapse the policy. They keep paying it. And so what's happening is a lot of companies that have guaranteed UL products are seeing financial hardship because of this. Now, in 2021, Ohio National, which was a mutual company, they demutualized. They got bought out by a stock company. They had guaranteed long-term rider annuities, I believe is what it was. It was a guaranteed product. That hurt them financially because those products did not lapse. Now, I believe that's what it was. I should have made sure of that, but I'm almost positive that's what it was. So when we have a UL product, that UL product does not have a cost of insurance built in. They have underestimated the cost of insurance. Well, that's not good for you, the policyholder. It's good for you because you think you're getting insurance at a discounted rate, but it's not good for you long term because those policies collapse. It's not good for the company long term if people continue to pay the premium and they don't die early because now we have to guarantee it. What is going to hurt a company financially is going to be the product that they did not price correctly. Then we have insurance agents that don't know their heads from their tails, and they come in and they just want to sell based off of an illustration and say, oh my gosh, this is fantastic. You should buy this. You're going to get this great rate of return. Or on the whole life side, this whole life product is better than this whole life product. We can get you underwritten in 2 days. Yes, there are insurance companies out there that will have underwriting approval in 2 days based on a certain death benefit, maybe $2 million of death benefit or less, will get you underwritten in 2 days. It's called express underwriting. No, thank you. Like, we have started to do it here. I don't love it. I would prefer nobody go through express or accelerated underwriting. I would prefer companies not even have that option because of the fact that if we don't go through full underwriting, how are we 100% certain that potential client or that potential insured is healthy? How do we know that? We don't, because we can't pull medical records. So I would prefer that we have to wait. I'm totally okay with that. But when we don't have agents that understand how the policy works, they don't understand how dividends are paid, they don't understand how the rate of return is figured in the policy. And it doesn't happen so much today, I don't believe. I haven't heard of what's going on today. But in the past, prior to 2022, people would say, oh, you're going to get a 4% guaranteed on this policy. 4%? That's a 4% gross rate. When I started in this industry, that's what I was told. I believed it until I did the research, and it is a gross rate, and it is based on a formula. There are companies that say you'll get a 5% dividend. That is a gross rate, and the dividend is based on a formula. Nobody has an exact rate of return in their policy. Everybody's is going to be different because it's going to be based on a formula. And so we as agents, some agents, will sell this based on sunshine and rainbows. And they're going to say, well, my company is better than your company because I offer more cash value. I offer more death benefit. Well, if a company is offering more death benefit, more cash value, are they being conservative or are they being aggressive just so they can sell life insurance? So we have a company that is kind of manipulating the numbers, underpricing their product, and we have an agent that is clueless and selling it based on numbers instead of a long-term look. I want my company to be around. until I'm 121 years old or until the babies that I write life insurance on are 121 years old. I don't want a company that is going to demutualize. I don't want a company that's going to get bought out by another company or actually go under, which that's rare. But I don't want any of that. And so when people are out there shopping for insurance, you better pay attention to what you're shopping for. If you have an agent that is trying to convince you that one company is better than another company because we pay bigger dividends, we have more cash value, we have more death benefit, how is that happening? Okay. These things are a big deal. So many of us just want to look at a rate of return because we're buying life insurance for the infinite banking concept. And I am sorry to tell you, but that is not the best way to look at this. We need to look at the company as a whole. And when we have huge companies like Ohio National, Lincoln Financial, and they have a bunch of guaranteed products on their book, financially, what is that going to do? If we have a company that's beating every other life insurance agent out of the gate, why is that? Now, the company that I work with, yeah, they look terrible on paper because they're conservative. But guess what? In 2008, they finished number one for the least amount of money lost in that financial crisis amongst all financial institutions. They came out smelling like a rose, while everybody else had a little bit of hurt applied to them because they're conservative. Now, at the end of the day, I am okay with that. They've actually done some other stuff that made them easier to work with. We've got some accelerated underwriting going on. All these, I don't like it. I don't like it. They just came out with a variable universal product that has a guarantee on it. No, thank you. Concerns me. I'm looking at all the companies. There's another company I write with. Super conservative company. They're writing a bunch of indexed UL. Holy moly. Now I'm really looking at their book. I did not realize they did that. I don't put a ton of business with them, but I put some business with them. I am always looking at the company as a whole. What agents are doing with that company? Because when I'm in this environment, I know agents that are doing premium finance. I know agents that are doing 1090s. If those agents are producing a lot of or writing a lot of policies with one particular company, I may just tend to back up a little bit. Okay. If there's an insurance company that just lets any agent in the world write insurance with them, does not care about the ethical standards of that agent, I am going to question that company because a company is just out to write insurance. Are they managing the financials? The insurance companies are held to higher standards than the banks. And clearly we saw Silicon Valley Bank had zero dang standards, zero. So when people say, is the insurance company better? Even the most lenient insurance companies are probably still better than a bank that has 0% in reserves. Then let me just make this comment. We're concerned about the insurance company. We're concerned about the banks right now. But have you looked at your 401ks, your IRAs, your stocks? Who's managing them? They can just willy-nilly lose money and you're totally okay with it. Where are their standards? And I talk to you guys about this all the time because it drives me insane. We hold insurance companies to standards. We hold banks to standards, but we don't hold the stock market to a standard because they have brainwashed us to believe that it is not necessary. It is part of the game, and that game is gambling, my friends. 100% gambling. If you went to the casino and you put $100 in the slot machine and you're up $200, and you're like, oh my gosh, I got $300 now. I only put 100 in. And then you lose it and you're back to 100. What do you say? Oh, well, I never had it anyway. So it's okay. I still left breaking even. I had a good time playing. Do you say that in the stock market? That's what they're telling us to say. I get this feedback all the time. Well, Mary Jo, the stock market lost money. I never had it anyway. That is the definition of gambling. Do I want to gamble with my retirement? Heck to the no, I don't want to. No, thank you. So I am not going to put my money there. I will gamble with my money under my control of maybe starting a business, maybe buying rental properties, doing other things with that money. But I sure the heck am not going to put it in the stock market and then hang in there. That is gambling, my friends. So we are holding everybody to a different standard. Yet everybody wants to hold the life insurance companies to the utmost standard. And you actually probably put less money into life insurance than you had in your IRA or 401k. If you are putting more into life insurance, you have every right to ask that question. You have every right regardless. I don't care if it's 5 cents or if it's $500,000. You have every right to ask that question. Just ask that question of everybody. So think about what the life insurance companies have been through. More than the banks, more than the stock market, more than 401ks, more than IRAs. Yet the majority of those companies are still here. They're still mutual. That should speak volumes for you. What should concern us is how many guaranteed products we have on the books. Guaranteed universal life, guaranteed variable annuities. Those type of products should scare the bejesus out of us. Here's the other thing. If we're going to buy a universal life product, an indexed UL product, a variable universal life, and throw a guaranteed insurance rider on there, meaning my death benefit's guaranteed even if cash value goes to zero. If I'm going to throw that rider on the policy, why didn't I just buy whole life where everything is guaranteed and priced correctly? Think about it. It's really that simple. Just go buy whole life. Quit thinking that the market's going to make some great rate of return. Pay for it. Quit being cheap about it. Quit chasing rates of return. Go to the stock market if you want to do that. But if you want your company to survive, buy good old-fashioned whole life where it is priced correctly. And stop comparing companies to companies chasing the best rate of return. Because if you remember, Nelson said it's not about a rate of return. Okay, that's all I got today, guys. If you have questions, comments, concerns, please let me know. Mary Jo at withoutthebank.com. I'm happy to answer those. I had a comment last week that I upset somebody because I called Dave the dipstick over a 15 versus a 30-year mortgage. I totally understand what they're saying, but the thought process is so incorrect, and it actually is going to hurt people today. If they have a 15-year mortgage, they lose their job and they can't refinance. But you know what? I love the feedback. I appreciate it. I still like whoever it is that listens. If I have not lost you as a listener, thank you for the comment. I appreciate it. We may not agree, but that's okay. We don't have to agree on everything. Okay, guys, if you need anything, let me know. Otherwise, have a fantastic rest of your day. Go to withoutthebank.com and grab your books.